So I've been holding this micro contract for a couple months now, and it's about time to close it. Now, the only reason I'm trying to close it today is that the micro contract is actually ending this week. And, so you got to close it and then reopen a new one, right? It's not like a stock where you can just hold it forever. The futures, they have their expiration dates several times a year. And so then you have to close it and reopen it if you want to maintain your position. So if I didn't have to do that, I would probably just continue to hold long on this. And that's not really a bad way to go about trading futures. Hold in the direction of the larger trend. All right, so this is the Micro E-mini, which is an index for the S&P 500, which generally has a bullish trend. So it's nice to take advantage of that bullish trend, and you can just kind of hold a small but leveraged position and take advantage of that. So I'm going to go ahead and close it.
Order filled.
So there we go. So we're out. Not a bad profit considering what your position size could be to have a Micro E-mini. Technically the margin required is only $50 to hold a micro contract, at least intraday. Now you wouldn't want to go that low on holding a micro contract. Really you should probably have, 5 or 10,000 if you wanted to plan on holding micro contract. But then let's say you have 10,000 in your account and you do that, and you're holding through something like this. You can make 12% in a couple months. That's a great return. But ideally, if someone wanted to do something like what I'm doing here, they probably should just try to hold it perpetually. So they buy it, and then every 3 months when that expiration comes up, then they close it at the end of that 3 months, and then they re-enter. And ideally, probably most people should not try to time that at all. So you can still do your day trading, do everything that you still want to do on one side of it. But on the other side, you're holding your stocks, or you're doing something like this, where you're holding a contract long. And just by doing that, just by holding long, you kind of avoid any mistakes that might be made inherently through trading. Let's say you have your 10-year view, and you say, I'm just going to hold long. I know there's going to be pullbacks, and I'll just sit through those and I'll hold long. Well, then when these tariffs happen, yes, on one side you can be day trading it and getting short during this, but on the other side, avoid those mistakes. And if you just sit through this, then you look at a few months later, then you're actually you're not going to make any of those mistakes by trying to exit the position or get long through here or try to short down here. You see, so you're going to avoid those mistakes just by holding it. And then maybe you'll have 3 months like this that look bad, or you'll have a year or two that look bad. But then if you look out 5 years, 10 years, then you're going to be way up compared to someone that was trying to actually manage it during this. So ideally, if someone exits their trade because the contract is ending, they should go ahead and just re-enter it. So I would roll forward to the next contract, which will be the December contract, and then I'll just click buy the market right now. For me, I am seeing a bit of a pattern where we might get more of a pullback today. So we have a possible wedge pattern right here. So first push, second push, and then a third push. So that little bear bar, that's often a sign that you can take profits below that bear bar, which is basically what we did right here. It's not really a strong enough sign to begin selling, but taking profits, that's a reasonable thing to do. And a lot of times it wants to ride back to the moving average at least and to see what it finds here. Around the moving average and around these prior highs, are there going to be buyers here, or are there going to be sellers and it breaks through? If it does break through, do we end up, I'm going to draw it on here. If it does break through, do we end up double topping here and going
Connection
lower?
Lost.
Does it end up breaking through, but then getting back above it and then heading higher? So looking at it as a day trader, that's what I'm thinking there. And so I'm going to re-enter this. I think it's okay to try to re-enter down here instead of just taking the more blind approach and trying to just rebuy here. Although I do think for most people that blind approach would be better given like a 5-year, 10-year timeline. Another reason is today's an FOMC day, and it's kind of an important FOMC day. This whole year we've been talking about rate cuts. Powell, Trump. This is the big one. So here are the odds. 93% chance we'll have a 25-point decrease. 5% chance there'll be a 50-point decrease. So it's very priced in that we're going to have a decrease of at least some sort. 3% chance there'd be no change. So if we end up having a no change today, then that would be a bearish shock to the market. Now, this announcement occurs at 2 o'clock. But what I found often that is even more important is what Powell says at 2:30. And he makes his statement at 2:30, and that's really what tends to move the market lately. The algorithms, everything they're reading his lips, they're reading his his facial expressions, and they're processing the words he's saying, and that's what really starts moving the market. So unless there's a big shock here, so we're expecting a 25-point basis decrease, and if we get that, the market probably wouldn't do anything too drastic. But then at 2:30, right, we have every eye in the world reading what Powell is saying, and then that tends to move the market more. And I do think that'll be the case for today. Our expectations are almost set in stone now of what's going to happen for this time. But then what he says is what's going to happen in the future, right? However he's speaking, that is what we can assume would change the odds for future rate cuts or increases. And those future predictions, that's what really moves the market. And, it's just a general rule of thumb to not have any trades going on during that FOMC. 15 minutes, really probably an hour before is better to just at least not take any more trades and be out of it before 15 minutes before the FOMC starts. And, wait at least 15 minutes after that FOMC ends. And like I said, in the last, I don't know how many years it's been now, but in the last at least couple years, or at least in the last year, Powell speaks at 2:30, and so that, like I said, the market really moves when he speaks at 2:30. So you want to wait till after that 2:30 is over, and then start trading there. So really, on FOMC days, you just probably just write off the whole afternoon, and watch it and understand what he's saying in it. But try not to be in any trades around that FOMC announcement. Another topic I wanted to cover is this crude chart. So looking at oil, I had made a video about a month ago and posted that during this bear bar, so August 19th. I was talking about how I thought oil would sell off, possibly down to 55, 56 down here, if we got below that bear bar. And we never ended up getting below this bear bar. So my thinking was we had a sharp sell off here, pulled back, and then we're looking for that second leg down and to break through below this level, below the 200 moving average, below this prior low. And we're setting up with the double top right around here, double top, triple top, but never went below the entry bar. So maybe you could have argued to sell here below this for a swing trade, but I think the better trade was here, and this is what we were discussing in that video, but never went below that bar. And since then, we've just been in this mess, this trading range. So as we go sideways, it kind of reduces the importance of whatever was to the left. So we were looking for a second leg down off of this, but the longer we go sideways, the less influential that big move is. So I think at this point, I'm pretty 50-50 on the direction of it. I think both sides are trying to trap each other. Buying here, for example, I think that's an okay swing trade. But in this case, it didn't end up as a winner. Or trying to sell somewhere over here. If you're doing it, you need to swing trade. Probably after a first bear bar low in the range like this, that's not a good enough sell. I would want a secondary short, which we didn't get. So in either way, both sides are trying to trap each other. It's a trading range. So at this point, I'd rather be buying like below bars, like below yesterday's low, or trying to sell up higher in the range. Maybe like above this bar, the August 1st high, or above the very top of that. So just wanted to follow up on that video from a month ago. And yeah, I was hoping we'd get gas prices even lower. Looks like not going to happen yet.